Welcome to the deep dive, where we cut through the noise to get you truly well informed. Today, we're tackling a pretty dramatic idea, one that gets thrown around a lot. What happens if no one buys American debt?
Right.
Now, on the surface, that sounds, well, almost impossible, doesn't it? The US Treasury market is just so central.
It is. Too vital to fail in that absolute literal sense.
But the real risk, the thing we need to dig into, isn't that total collapse. It's what we're calling demand impairment.
Exactly.
So our mission for this deep dive is to unpack the plausible scenarios around that impairment. What could happen? What are the consequences? And really, what does it mean for you? Because this isn't just abstract economics, right?
Not at all. It hits financial stability, borrowing costs everywhere, even your personal investment portfolio.
Yeah.
Look, the U.S. Treasury market, it's the bedrock. It's the foundation of the global financial system. It will always clear at some price.
Okay.
The critical question, the thing we need to understand, is what that price is. And crucially, how much intervention is needed to get there.
That's where the risk lies.
That's where the real risks and implications start.
Chapter 1. The U.S. Treasury market. Bedrock of global finance. Okay, let's unpack this then. We call it the bedrock of global finance. But how does this massive market actually function day to day?
Well, it's highly structured, very transparent, actually. The Treasury funds the government by selling securities, bonds, bills, notes, through regular auctions.
Okay.
And it's a single price system. That means all the successful bidders pay the same price, which is based on the highest accepted yield in the auction.
And who's bidding?
You get two main types. They're competitive bids, mostly from large institutions, banks, funds. They specify the yield they want. And then non-competitive bids, think individual investors, smaller players. They basically say, I'll take whatever the yield ends up being.
Okay, but here's where it gets really interesting, right? This whole system leans heavily on a group called the primary dealers.
Absolutely crucial. There are about 25 of them, big financial institutions. They're essentially the underwriters. They have an obligation to participate in every auction.
An obligation, so they have to show up.
They do. They have to put in meaningful bids, and they also make continuous markets afterwards, buying and selling these securities. They're the backstop, in a way.
But there's a catch, isn't there? Something about regulations.
Yeah, exactly. Post-2008 rules, especially the supplementary leverage ratio, the SLR, create a bit of a hidden vulnerability.
How so?
Well, the SLR treats low-risk assets like treasuries pretty much the same as riskier assets when calculating leverage. So think about it. During market stress, when the government might be issuing more debt,
Right.
the dealers are needed most to absorb it. But buying more treasuries makes their balance sheets swell, pushing them closer to those SLR limits.
Which restricts their ability to buy more just when they're needed?
Precisely. It's pro-cyclical. We saw this exact tension back in March 2020. The Fed actually had to temporarily exempt treasuries from the SLR calculation just to keep the market functioning smoothly.
Wow. Okay, so if the dealers face these constraints, who actually owns all this debt? Who are the big buyers for treasuries these days?
Yeah, this is really important. There's been a changing of the guard among buyers. Historically, you had a lot of, let's call them price-insensitive buyers.
Like who?
The Fed itself, through QE, quantitative easing, or foreign central banks buying treasuries as reserves, maybe for policy reasons, not purely for yield.
Okay.
But that landscape is fundamentally shifted. As of, say, mid-2025, with total public debt around, $36.7 trillion.
It's a huge number.
Yeah. The marginal buyers, the ones setting the price at the edge, are increasingly price-sensitive private investors.
Meaning?
Domestic households, pension funds, insurance companies. They care about the yield. They demand more compensation for the risk, for the duration they're taking on.
So they need a higher return.
Exactly. Which means a higher term premium is needed. That likely leads to structurally higher baseline borrowing costs for the U.S. government going forward.
Even with big foreign holders still there, like Japan, China.
Well, yeah, foreign investors is still huge. Japan holds over $1 trillion, the UK maybe $800 billion, China around $750 billion. But their marginal demand, their influence on the next price, isn't what it once was compared to these domestic price-sensitive buyers.
Okay, so let's quickly summarize Chapter 1 then. We've got the Treasury auction system, single price, relies heavily on primary dealers.
Right.
But those dealers face regulatory constraints like the SLR, which can limit their capacity, especially in stressed times.
Yeah.
And maybe most importantly, the buyer base has fundamentally shifted away from price-insensitive official players towards price-sensitive domestic investors,
Sure.
which means baseline U.S. borrowing costs are probably structurally higher now because these new buyers demand a higher term premium.
That's the key takeaway.
Chapter 2. Defining demand failure. From stress to crisis. Okay, so when we talk about demand for U.S. debt failing, it's easy to picture this like sudden catastrophic event. But you're saying it's more nuanced, a
Yep.
spectrum.
Exactly. It's not an on-off switch.
Yeah.
Demand failure is really a spectrum where the yield required to clear the market becomes progressively more damaging, more destabilizing.
Right.
We can think about it using a kind of four-tiered framework. Let's start with the mildest form.
Okay.
A, auction stress. This shows up in the auction data. You might see consistently weak metrics, like a low bid-to-cover ratio, maybe below 2.3x, meaning less demand relative to supply,
Uh-huh.
or a large positive auction tail. That's the gap between the average yield and the highest yield accepted. If that tail gets bigger than, say, 1 or 2 basis points regularly, it's a little yellow flag. Maybe dealers are having to take down a bigger chunk too, like over 15–20%.
So signs of indigestion, basically.
Sort of, yeah. Early signs. Then you move to B-buyer mix shift. This is more structural, slower erosion. Maybe you see a sustained fall in those indirect bids.
Yeah.
At auctions, it's often seen as a proxy for foreign demand. If that share drops consistently below, say, 60% from its current level, around 65%, that's a structural shift worth noting.
Okay. Getting more serious. What's next?
C, price-insensitive backstop only. This is where things get dicey. The market basically only clears because a big price-insensitive entity steps in.
Like the Fed.
Exactly. The Fed intervening directly with QE, maybe even yield curve control, or YCC. Or it could be regulators twisting arms, maybe relaxing SLR again, or finding ways to compel banks or funds to buy treasuries. Essentially financial repression.
Right. And the worst case.
D, absolute failure. This is the extreme tail risk. We're talking a truly failed auction, something unprecedented for the U.S., where the bid-to-cover ratio for competitive bids actually falls below 1.0.
Meaning not enough bids to cover the amount offered.
Precisely. And likely coupled with a seizure in the Treasury repo market. That's the crucial short-term funding market. If that freezes up,
Big trouble.
huge trouble. It triggers a system-wide dash for cash. Everything gets sold. So this really brings up the question, what does it mean for the market to refuse to clear? It's not zero demand. It's when that clearing yield, the interest rate needed, becomes so high, it's just economically and politically unsustainable.
What happens then? What are the real-world impacts when yields get that high?
Well, the consequences are severe. Think widespread insolvency. Banks, pension funds, insurance companies, their bond portfolios take massive hits. We saw a mini version with the regional banks in 2023. This would be systemic.
Okay.
It could spark a huge deleveraging cascade. Margin calls forcing asset sales, including treasuries themselves, making things worse, like March 2020 or the UK gilt crisis in 22.
Right.
And critically, the cost of servicing the debt becomes politically impossible. It starts crowding out everything else, defense, social programs, infrastructure. That hits everyone.
Okay, so wrapping up chapter 2. Demand failure isn't a cliff, it's a spectrum from mild stress to acute crisis.
Yep.
Defined by how high the yield needs to go to clear auctions. We laid out 4 stages: auction stress, buyer mix shift, reliance on a price-insensitive backstop, and absolute failure.
Right.
And the critical point isn't a specific number, but when that yield becomes so high, it breaks things, causes financial instability, or forces massive, extraordinary policy intervention.
That's the crux of it.
Chapter 3, the trigger map and early warning dashboard. So what could actually push us down that spectrum towards severe impairment? Are there specific triggers we should be watching, warning signs on the horizon?
Yeah, there are several potential triggers we need to monitor closely. First, and maybe most obviously, is the fiscal trajectory. There's a continued clear worsening of the federal debt-to-GDP ratio, leading to a loss of investor confidence. CBO projections paint a concerning picture there already.
Okay, fiscal issues. What else?
Geopolitical shocks. Imagine a strategic decision by a major foreign holder, like China or Japan, to actively and significantly sell off their treasury holdings. That could certainly rattle markets.
Plausible.
Third is market structure fragility. We've seen this before. Liquidity crises can be amplified by non-bank players.
Yep.
Remember the hedge fund selling in March 2020? Or the UK pension funds with their LDI strategies in 2022? that plumbing can break.
Right, the non-banks.
And finally, a monetary policy error. This could be the Fed losing credibility on inflation control, or markets starting to believe the Fed is basically being forced to finance government spending, what we call fiscal dominance.
Okay, quite a few potential triggers there. That sounds like a lot to track. You mentioned an early warning dashboard. How does that help make sense of it all? Can it really give us a heads up?
It can, but it's about focusing on the right signals, not getting lost in the noise. Our dashboard groups key indicators. Under auction metrics, we're watching that 10-year auction tail. If it consistently pops above, say, 2 basis points, that's amber. Above 4, that's red. Same for bid to cover, primary dealer takedown, the indirect bidder share.
Okay, so auction health.
Then volatility and risk premia. The MVE index is key. Here, it's like the VIX for bonds. If that spikes above 125, maybe a 150, that's a clear warning sign of stress. We also track the term premium itself.
Got it. What else?
Funding markets. This is critical plumbing. We watch the SOFR-IORB spread that tells us about stress and overnight bank lending. If it goes positive, that's unusual. We track Treasury repo fails borrowers not returning collateral. If the fail rate jumps above 2%, maybe 5%, that's serious liquidity stress.
Right.
Also, how much the Fed's standing repo facility is being used.
Right, the Fed's backstop facility.
And finally, FX and global flows. Big sudden moves in the dollar index, DXY, or consistent net foreign selling of treasuries reported in the tick data, those are signs of global shifts.
Okay, that's a comprehensive list.
But what's really fascinating and crucial to understand is that these indicators aren't independent. They're deeply interconnected.
How so? Feedback loop.
Exactly. Powerful feedback loops. A slightly poor auction might strain dealers, which leads to stress in the repo market, which causes the MOVE index to spike, which forces yields higher, potentially leading to an even worse auction next time. Mild stress can escalate very quickly.
Okay, so summarizing Chapter 3, potential triggers range from fiscal worries and geopolitics to market plumbing issues and Fed policy mistakes.
Right.
We can monitor these using an early warning dashboard, looking at auction results, bond volatility like the MOVE index, stress in funding markets like repo, and global capital flows.
Yep, T categories.
And crucially, these signals are all linked. Feedback loops can turn small problems into big ones fast.
That interconnectivity is key.
Chapter 4, the Policymaker's Playbook, Tools, Constraints, and Precedents. So if things do start to escalate, if we see those warning signs flashing red, policymakers aren't just going to sit there, right? What's in their playbook? What can the Fed and the Treasury actually do?
No, they definitely wouldn't stand idly by. The Federal Reserve in particular has a very powerful toolkit. First, you have the conventional and unconventional tools. Obvious one is cutting interest rates potentially back to zero.
Right.
Then there's quantitative easing, or QE, large-scale asset purchases. We saw this massively in 2008 and again in 2020. In March 2020, the Fed bought something like $1.6 trillion in treasuries and mortgage-backed securities in just a few months, basically saying they'd buy in the amounts needed to restore market functioning.
Huge intervention.
Huge. And then there's yield curve control, or YCC. That's where they explicitly target yields on specific maturities, setting caps. The U.S. actually did this during World War II. It's controversial. Japan's experience shows challenges, but theoretically on the table.
Okay, QE, YCC, what else?
Then you have the liquidity and backstop facilities. The Standing Repo Facility, SRF, is now a permanent feature, offering up to $500 billion in overnight cash against Treasury collateral to eligible banks. It's meant to prevent repo market seizures. There's the traditional discount window for banks. And crucially, the Fed's emergency Section 13(3) authority. This lets them lend to non-banks in unusual and exigent circumstances, which they used heavily in 2008 and 2020 to create special facilities for money market funds, primary dealers, even corporations.
So a lot of firepower at the Fed. What about the Treasury?
The Treasury's toolkit is more focused on debt management. They can change what kinds of debt they issue, maybe issue more short-term bills instead of long-term bonds to reduce duration risk or meet specific demand.
Okay.
And they've recently reestablished buyback operations. These are mainly for cash management and smoothing market liquidity now, but in a crisis, they could potentially be scaled up to support prices more directly, though the Fed's tools are far more powerful for crisis fighting.
Got it. So if we see these massive interventions, especially from the Fed, what does that lead to? You mentioned a term earlier.
All right, financial repression. If a crisis requires sustained, large-scale intervention like massive QE or YCC, it often leads down this path. Mhm. Financial repression is basically a set of official policies designed to channel funds to the government at artificially low, often negative, real interest rates.
The stealth tax.
Exactly. It's a way to inflate away the debt burden, a sort of stealth tax on savers whose returns don't keep up with inflation. The U.S. used forms of it after WWII, like with Regulation Q capping deposit rates. Modern QE and YCC can be seen as contemporary versions.
And what about history? Any lessons from past crises on how this plays out?
Oh, absolutely. History is full of lessons here. The minor 1979 U.S. technical default, just an operational glitch, showed even small failures can permanently raise borrowing costs. Trust matters. The 2011 U.S. S&P downgrade, following a debt ceiling fight, showed the dollar's reserve status is a powerful buffer against political shocks, but maybe not an unlimited one. The 2020 dash for cash was critical. It showed modern crises are really liquidity crises, often amplified by leveraged non-banks like hedge funds, and they require an overwhelming dealer of last resort response from the central bank.
Right.
The 2022 UK gilt crisis hammered home the importance of fiscal credibility and, again, how leveraged players, this time pension funds, can amplify stress dramatically.
Yeah, the LDI crisis.
And maybe the most powerful lesson comes from the Eurozone crisis in 2012. Mario Draghi's "whatever it takes" speech showed that a credible, unlimited central bank backstop can actually stop a self-fulfilling crisis of confidence in its tracks.
So the takeaway is?
The modern crisis template really demands a rapid, overwhelming response from the central bank, acting as the ultimate dealer of last resort. Hesitation can be fatal.
Okay, let's summarize Chapter 4. The Fed has a very powerful toolkit: QE, YCC, potential emergency liquidity via SRF, and 13.3.
Yep, a big arsenal.
Treasury's tools are secondary debt management, buybacks.
More supportive roles?
Sustained intervention often leads to financial repression, that stealth tax on savers.
A likely consequence.
And history teaches us modern crises are often liquidity failures amplified by non-banks needing a massive, fast central bank response. The dealer of last resort is key.
That's the template.
Chapter 5, Scenario Analysis, Probabilities and Pathways. All right, let's try to bring all these pieces together. Can we outline a few plausible scenarios, maybe with some rough probabilities for what could actually happen if demand for U.S. debt starts to seriously falter?
Yes, let's map out 3 potential pathways. First, our base case, S1, soft impairment. We give this maybe a 65% probability.
Okay, the most likely. What does that look like?
This is more of a gradual, persistent grind higher in yields. Think maybe 150, 200 basis point rise in the 10-year Treasury yield, but spread out over 12 or 24 months. Auctions show that mild stress we talked about, slightly wider tails, lower bid to covers, but they still clear without needing emergency Fed action.
What triggers this?
Could be those worsening CBO fiscal projections just sinking in, or the ongoing shift of price-sensitive buyers simply demanding more compensation. Maybe sticky inflation plays a role.
And the policy response?
Fairly adaptive. The Treasury might shift issuance more towards the short end. The Fed might slow down or pause quantitative tightening, QT. Probably continued political gridlock on any major fiscal changes.
And the market impact?
You'd likely see a persistently steeper yield curve. The movie index stays elevated, maybe in the 120, 150 range. Corporate credit spreads widen. Equity PE multiples compress, especially for growth stocks. Probably leads to a mild recession. Slower growth, higher baseline rates.
Okay, that's S1. What's the next level?
That's 2.
Okay.
Backstop required. We'll find this, say, a 30% probability. This is sharper, more disorderly. Imagine yield spiking, maybe over 75 basis points in just a few weeks.
Wow, fast.
Yeah, market liquidity dries up fast. Bid-ask spreads blow out. You see several really poor auctions. Clear stress in funding markets, volatile repo rates.
And the trigger here?
Could be something more acute. A geopolitical conflict escalates significantly. A really contentious debt ceiling fight that goes down to the wire. Or maybe a major financial institution suddenly fails, sparking contagion fears.
Right. So what did policymakers do in S2?
Here, the Fed has to step in decisively. They'd likely flood the system with liquidity via the SRF, probably halt QT immediately, and announce a new round of QE, framed as being for market functioning. They might even implement YCC, maybe targeting the 2 to 5 year part of the curve to anchor borrowing costs. Treasury would heavily skew issuance short-term.
And the market reaction?
You'd see that initial violent spike in yields, but then likely a sharp rally once the Fed intervention is clear and credible. The U.S. dollar might jump initially that flight to liquidity again, but then probably weaken over the medium term as the inflationary implications sink in. You'd see rising inflation expectations, gold would likely rally. The scenario basically defines a regime of fiscal dominance and financial repression.
Okay, that's quite serious. What's the worst case? S3.
S3. Acute dysfunction. This is the real tail risk, maybe a 5% probability. This is the full-blown systemic crisis scenario.
Like what?
Like a true failed auction, bid to cover below 1.0, the Treasury repo market freezes dealers unwilling or unable to finance positions. A massive cross-asset dash for cash ensues, margin calls everywhere, forced selling of everything, including Treasuries themselves.
What on earth could trigger that?
Needs a severe exogenous shock, most likely. A major successful cyber attack on critical financial infrastructure. A sudden, direct military escalation between major powers. Maybe even a domestic event that questions government continuity. Really extreme stuff.
And the response?
Immediate, overwhelming kitchen sink response. Uncapped QE, unlimited repo operations, massive central bank swap lines globally, new 13 facilities created on the fly. Treasuries might even have to temporarily suspend auctions, a true whatever-it-takes moment.
And the market pathway?
Extreme volatility. Multi-standard deviation moves across every asset class. A violent, uncontrolled yield spike, likely followed by an equally violent rally as the Fed steps in. The US dollar could even flash crash initially before surging massively as the global scramble for dollar liquidity becomes paramount. A long-term damage to the credibility of US markets and the dollar's risk-free status could be significant.
Wow, okay. It's crucial to remember those probabilities, right? S1 is the base case, but S2 and especially S3, while less likely, have enormous potential impact.
Exactly. You weight the probabilities, but you have to understand the potential severity of the tail risks.
So quick summary for Chapter 5, S1, soft impairment, 65% prob, gradual rise in the term premium, higher baseline yields, steeper curve, slower growth, but no acute crisis.
The slow grind.
S2, backstop required, 30% prob, sharp shock forces the Fed back in with QEYCC, contains the crisis but raises inflation risks and ushers in financial repression.
Intervention becomes necessary.
S3, acute dysfunction, 5% prob, true failed auction, repo freeze, dash for cash. Requires a massive, whatever-it-takes response, causes extreme volatility, potential long-term credibility damage.
Tail risk scenario.
Chapter 6, transmission channels, from Wall Street to Main Street. Okay, this all sounds pretty intense for Wall Street for financial markets, but let's bring it home. How does a crisis of demand in the Treasury market actually affect you, the listener, your everyday life on Main Street?
Yeah, the transmission is unfortunately quite direct and can be very rapid. Let's think about the immediate shockwave, say in the first week, T plus 0 to T plus 7 days.
Okay, what happens first?
Benchmark Treasury yields spike, probably violently. The MOVE index, that bond volatility measure, surges. You see immediate stress on primary dealers, market liquidity evaporates, repo rates become volatile or spike, and you see an increase in repo fails.
Seize up.
Right. Money market funds also feel the heat, especially prime MMFs that hold corporate debt. You'd likely see a flight to safer government-only MMFs.
And the dollar, does it crash?
Counterintuitively, often not initially, you frequently see a dash for dollars rally. Despite the crisis originating in the U.S., global finance runs on dollars, so in a panic, everyone needs dollar liquidity now. That can push the dollar higher in the short term. It's a key point many miss.
Ah, okay, that's interesting. So what happens after that initial shockwave, say, over the next 1 to 3 months?
That's when it really starts hitting Main Street. Mortgage rates are typically priced off the 10-year Treasury yield. So if the 10-year yield jumps 100 basis points, expect mortgage rates to follow suit pretty quickly. That puts a major chill on the housing market.
Big impact there.
Definitely. Then credit spreads widen. Corporate bonds, municipal bonds, they're all priced relative to Treasuries. So the base rate goes up, and the extra spread investors demand for risk goes up too. That tightens borrowing conditions for businesses, big and small. Less investment, maybe layoffs.
Okay.
Equity multiples compress. Higher Treasury yields mean higher discount rates used to value future earnings. That hits stock prices, especially those long-duration growth stocks whose valuations rely heavily on profits far out in the future.
And banks, we saw issues in 2023.
Right. Bank balance sheets take a hit. Rapidly rising rates cause mark-to-market losses on their existing bond portfolios, those accumulated other comprehensive income, or AOCI, losses. That erodes their capital base and makes them less willing or able to lend, further tightening credit conditions.
Okay, so that's the medium term. What about the longer view, say 6 months to 2 years out?
The long-term macro regime really depends on which scenario played out and the policy response.
Path dependency.
Exactly. If we went down the S1 pathway, soft impairment, without massive Fed intervention, the sustained higher yields likely lead to a classic disinflationary recession. Reduced consumption, lower investment, rising unemployment. Eventually, that would bring inflation down, but at a significant economic cost. Painful adjustment.
And the other path, S2 or S3.
If we had an S2 S3 pathway
Right.
requiring that massive Fed backstop large QE, maybe YCC, then the big risk becomes inflationary fiscal dominance. If the Fed is essentially forced to keep printing money to suppress yield and finance ongoing government deficits,
Right.
you risk embedding persistent higher inflation into the system. That erodes the real value of savings, people's purchasing power. It's that unpleasant monetarist arithmetic situation.
Two very different, unpleasant long-term outcomes.
Pretty much. Either painful recession or potentially damaging inflation.
Okay, so let's recap Chapter 6. A Treasury shock hits fast. Yield spikes, volatility, funding stress, maybe a weird initial dollar rally.
An immediate wave.
Then over 1-3 months, it hits Main Street. Sharply higher mortgage rates, tighter credit for businesses, falling stock valuations, pressure on banks.
The intermediate impact.
In long term, 6-24 months, it's likely either a disinflationary recession if rates stay high, or inflationary fiscal dominance if the Fed has to permanently suppress yields, higher unemployment, or eroded savings.
That's the difficult trade-off.
Chapter 7. Debt sustainability under duress.
Okay, let's really drill down on the numbers now, because the core long-term risk here isn't just selling the debt day to day. It's whether the total burden becomes unsustainable. You mentioned that unpleasant arithmetic, RG.
Exactly. The unpleasant arithmetic of RG is fundamental to debt sustainability. It simply says the change in the debt to GDP ratio depends on the relationship between the real interest rate the government pays on its debt and the real rate of economic growth, G.
How does it work?
If R is less than G, RG, the economy is growing faster than the cost of servicing the debt. If the government runs a balanced primary budget, revenues equal spending, excluding interest, the debt ratio will actually shrink over time. It's manageable.
Oh.
But if R is greater than G, RG, the debt burden grows faster than the economy, even with a balanced primary budget. The debt ratio becomes unstable and tends to grow exponentially unless the government runs significant primary surpluses.
And a demand crisis. A demand crisis pushes R sharply higher, potentially flipping a previously manageable ARG dynamic into a dangerously unstable ARG situation very quickly.
Right. So what do the projections actually look like if we layer these demand impairment scenarios onto the U.S. debt outlook? How bad could the interest costs get?
It gets alarming fast. Let's look at some modeled impacts on debt service costs, maybe looking out a decade based on CBO baselines in our scenarios.
Okay.
The CBO baseline assumes maybe an average 10-year yield around 4.1%. That leads to annual interest costs of roughly $1.6 trillion, consuming about 16.5% of all federal revenues, and pushing debt held by the public to maybe 116% of GDP. Still high, but that's the baseline.
Okay, now the shocks. S1.
S1. Soft impairment, let's say that adds 150 basis points, so an average yield around 5.6%. Annual interest costs jump to $2.4 trillion. That's 22.8% of federal revenue eaten up just by interest payments. Debt to GDP rises faster, maybe to 127%.
Nearly a quarter of revenue just on interest.
Wow.
S2.
S2. Backstop required. Let's model a bigger 300 basis point shock. Average yield 7.1%. Now, annual interest is $3.3 trillion. That consumes 28.5% of federal revenue. Debt to GDP heads towards 140%.
Over a quarter of revenue. And S3.
S3. Acute dysfunction. A massive 500 basis point shock, average yield 9.1%. Annual interest explodes to $4.5 trillion. That would consume an incredible 36.0% of all projected federal revenue. Debt to GDP blows past 150%, heading towards 160%.
36%. I mean, that's just staggering. That's more than Social Security costs, more than defense spending. How is that even politically possible?
It becomes politically untenable. That's the point. A demand crisis doesn't just make the long-term fiscal challenge worse. It pulls it forward, makes it an immediate acute crisis. It forces incredibly difficult choices about spending cuts or tax hikes that are politically toxic, severely limiting any other policy goals.
So to wrap up Chapter 7, debt sustainability really hinges on that RG relationship, and a crisis blows our way up.
It makes it potentially explosive.
Even a soft impairment, S1, could push interest costs to nearly 23% of federal revenues within a decade.
A huge burden.
More severe shocks, S2, S3, could see interest devour 28% to 36% of all revenues, making the fiscal math basically impossible without drastic action.
Unmanageable territory.
So a demand failure crisis turns the long-term U.S. fiscal challenge from chronic into acute almost overnight.
Exactly. It forces the issue.
Chapter 8. Retail Portfolio Stress Test and Cross-Asset Playbook. All right, let's bring this right down to the individual investor. For our listeners thinking about their own portfolios, what does all this mean? How can they stress test their holdings against these kinds of scenarios?
Yeah, this is where the rubber meets the road for personal finance. Let's look at different asset classes,
Right.
starting with fixed income.
Okay, bonds.
In an S1 scenario, soft impairment, rising rates, long-duration bonds get hit hard. A 30-year Treasury bond could easily fall 20% or more in price if yields rise 1.5%. Short-term Treasury bills, on the other hand, are relatively safe from price declines and benefit from rising yields.
So duration risk is key.
Huge. Now, in S2, S3, you might see initial sharp losses in bonds, but then potentially a massive rally if the Fed steps in with QE or YCC to force yields back down. It becomes very tactical.
What about inflation-linked bonds like TPS or I bonds?
They likely be a good hedge in that S2 inflationary scenario where the Fed intervenes heavily. Less effective in an S1 disinflationary outcome, and potentially caught in liquidity selling during an acute S3 crisis.
Okay. And credit. Corporate bonds, junk bonds.
Credit spreads widen across the board in any stress scenario, but high-yield HY bonds, junk bonds, get absolutely hammered far more than investment-grade IG bonds during a flight to quality. The riskiest stuff suffers most.
Makes sense. What about equities, stocks?
The S1 scenario with rising discount rates is particularly tough on high PE growth stocks. Think tech, unprofitable innovation names. Their valuations get crushed.
So value over growth.
Generally, yes. Quality companies, those with strong balance sheets, consistent cash flow, low debt, maybe pricing power tend to hold up much better. Resilience becomes key.
How about financials, banks?
Kind of a mixed bag. Rising rates cause those AOCI losses on their bond holdings, which hurts capital. But a steeper yield curve, if it emerges, can actually help their core lending business by improving net interest margins. So it depends.
Okay. What about real assets and alternatives? Gold, commodities.
Gold is the classic safe haven asset. It tends to perform well during periods of fiscal stress, monetary debasement fears, like our S2 inflationary scenario. Industrial commodities might suffer in an S1 recession, but could do well if S2 leads to higher inflation expectations.
And foreign assets,
Right.
currencies. Should people ditch the dollar?
Long-term diversification into other currencies like the Swiss franc or Japanese yen or foreign assets generally makes sense to mitigate dollar concentration risk. However, remember that paradoxical short-term effect. In an acute S3 liquidity crisis, the dash for dollars is highly likely, pushing the dollar up initially, so timing is tricky.
Right, that dollar rally trap. Okay, lastly, cash and equivalents, like money market funds.
Extremely important in a crisis. Government-only money market funds, MMFs, should remain safe havens. But prime MMFs, which hold commercial paper and other short-term corporate debt, are vulnerable. They faced stress in 2008 and 2020. They could potentially break the buck, fall below $1 NAV, or impose withdrawal gates in a severe crisis. So knowing what's in your MMF is crucial.
Definitely. Okay, this is a lot to juggle. But you've put together a kind of conditional playbook, right? It's something practical investors can use based on market signals.
Yes, we tried to create an investor playbook based on observable signals, linking back to our dashboard. It's conditional, meaning if X happens, then consider Y.
Okay, give us some examples.
So if you start seeing signs of S1, soft impairment like the 10-year auction tail consistently above 2 basis points, and then the index stays elevated above 125, then consider reducing duration in your fixed income. Maybe shift from long-term bonds to short-term T-bills and rotate some equity exposure from high growth towards high-quality value stocks.
Okay, adjusting for rising rates. What about S2?
If the Fed signals S2, backstop required, maybe they halt QT suddenly, announce new QE, then think about increasing allocations to inflation hedging assets like TPS or gold. Tactically, you might even consider adding some bond duration back, anticipating the Fed will successfully suppress yields, at least for a while.
Riding the Fed's coattails, essentially. And S3.
If you see signs of S3, acute dysfunction like the Fed's SRF usage soaring above $250 billion and D reports of widespread repo fails, then the priority is maximum safety and liquidity. Maximize holdings of cash and short-term T-bills. Double-check your MMFs are government-only. Reduce or eliminate all forms of leverage in your portfolio. Hunker down.
Very clear conditional actions. Okay, so wrapping up Chapter 8. In a demand crisis, long bonds suffer, T-bills are safer. High-yield credit gets crushed worse than IG.
Check.
Quality stocks tend to beat growth. Gold can hedge inflation risk. The dollar might rally strangely short-term in extreme stress.
P dynamics.
And that conditional playbook, tied to market signals like auction results or Fed actions, can guide adjustments around duration risk, inflation hedging, and maximizing liquidity.
It provides a framework for reacting.
Conclusion: navigating the unthinkable. We have covered a huge amount of ground today. I think the core idea, the thesis we keep coming back to, is that the real risk isn't some literal absolute failure where nobody buys U.S. debt. It's a severe demand impairment where the market still clears, yes, but only at yields that cause a crisis.
Exactly. And that presents this incredibly difficult dilemma for policymakers. They face a stark choice. Either they allow the high rates needed to attract buyers, which likely means a painful economic contraction, widespread private defaults,
The recession pass?
right? Or they intervene massively to force rates down, large-scale debt monetization via QE or YCC, which avoids the immediate pain but risks embedding higher inflation and potentially debasing the currency over the long term.
The inflation path. No easy answers.
Not at all.
Now, we've acknowledged the Fed has this incredibly powerful toolkit. They can act as the dealer of last resort. But we absolutely have to underscore the significant costs and consequences of that intervention.
Absolutely.
It blurs the lines between monetary and fiscal policy. It increases the risk of fiscal dominance, where the central bank loses its independence. And ultimately, it can erode the purchasing power of the dollar, which impacts everyone.
These are not free lunches. There are serious long-term trade-offs involved in these interventions.
So bringing it back one last time to our listeners, what's the ultimate takeaway? How should they navigate this potentially more volatile future?
I think the core message for investors is to focus on resilience in their portfolios. That means prioritizing businesses with strong balance sheets, durable earning streams, and ideally, pricing power, the ability to pass on cost increases.
Quality matters.
Quality matters hugely. It also means considering tangible assets, like gold, that can hold value during periods of financial stress or monetary debasement. And importantly, practicing prudent global diversification, not having all your eggs in one basket, geographically or by asset class. Makes sense. Build a more robust portfolio.
Build for resilience against a wider range of outcomes.
So maybe the final thought for everyone listening is this. Prepare for a future where the cost of money, interest rates, might be structurally higher, and where the value of that money might be less certain than we've become accustomed to.
That captures the potential regime shift quite well. We really hope you found this deep dive incredibly insightful and helpful. If you did, please take a moment to like this video and subscribe to this StockAnalytics.AI YouTube channel. We do deep dives like this regularly to help you get well-informed quickly. And just the standard reminder, the content in this deep dive is for informational purposes only. It is definitely not financial advice. Please consult with a qualified financial professional before making any investment decisions. Also, please note that AI was used in the research and creation of this video script. Thank you so much for your insights today. Really appreciate you walking us through all of that.
My pleasure. It's a critical topic.
And thank you for joining us on the deep dive. We'll see you next time.